Welcome everyone, and thank you for joining our webinar. Today's topic will be the state of the ophthalmology sector 5 years into private equity investment. A few things to keep in mind throughout the presentation. All attendee lines will be muted throughout the webinar. At the end of the presentation, there will be time for questions. You can ask questions by typing within the Q&A section located in the control bar, which is most likely located at the top or bottom of your screen. This webinar will be recorded and it will be distributed next week. Today's speakers include Jonathan Gorski, who's a partner at Edelstein and Company, and Eric Major, who's a vice president at Provident Healthcare Partners. I will now turn it over to Eric to give a brief introduction on Provident.
Great. Thank you for the introduction. Thank you all for joining. So a quick introduction on Provident Healthcare Partners. We're an investment bank that's been in business for a little over 20 years. We have offices in both Boston and Los Angeles and work on transactions across the country. Our role in the process is predominantly as sell-side advisors. So we're engaged by healthcare services companies looking to explore options, whether it's partnering with a private equity firm, partnering with a public acquirer in rare cases, or potentially aligning with a strategic group that typically is private equity backed. We spend most of our time in and around the physician services sector, although we do work across all of healthcare. Within physician services, there are a number of specialties we've outlined here, transactions that we've either closed or areas where we're actively working on deals. We've obviously seen a lot of activity across the entire physician services spectrum. One of the areas where we've seen the most activity in the last 5 years is ophthalmology, which we'll be discussing in this webinar. Our firm has closed approximately 50 physician practice deals since the beginning of 2014, including 6 transactions within the ophthalmology sector. I'll hand it over to Jonathan for an introduction on Edelstein.
Good afternoon, everyone, and thank you to Eric and to Provident for allowing Edelstein and myself to be a part of today's presentation. We're actually located right around the corner from Provident and in Boston, and we collaborate with them quite often. I've been told they have a very thick Boston accent, so type in a question if you'd like me to say park or car. I can certainly try to accommodate that request. A little bit about Edelstein that might not be on your slide, that we have 15 partners that service 4 specialized niches. We're in tax, audit, valuation, and of course healthcare, of which I am a partner. The niches span a variety of specializations and industries, including many specializations within the healthcare group. Selfishly, being spawned in a CPA firm has really helped our healthcare practice service our clients in terms of tax, valuation, audit, and all the specialized services that we do offer to the healthcare groups. A sample and some examples of those specialized services are located on the slide. There's also a sample of the clients that we service on the right-hand portion of the slide. And there's a terrible picture of me at the bottom right-hand portion of the slide. If you'd like to learn more about Edelstein, feel free to visit our website at www.edelsteincpa.com, or you can feel free to contact me directly, as my contact information will be at the end of this presentation. So without any further delay, I'd like to kick it back over to Eric, and we hope that you find our information useful today.
Great. Yeah, so just looking at the next slide, so just some sample transactions that we've worked on within the physician sector. Most of these have closed within the last few years. We've obviously worked with a diverse group of ophthalmology practices, across the country, ranging from the Mid-Atlantic region in the Northeast, Midwest, the Southeast, as well as the Western part of the country as well. And worked with groups that are typically surgery focused, so they may have an optical and optometry component, but all of these practices are predominantly focused within ophthalmology. We've also worked on a number of physician areas where we're seeing very similar trends in terms of consolidation across GI, women's healthcare, orthopedics, primary care, multi-specialty. All of these areas see very similar trends that we're seeing within ophthalmology, and a lot of the same investors that are in ophthalmology have also been active in other areas outside of this specialty. Moving to the next slide. if we look at the eye care market, as a whole, I think there's several subsectors within it where we're seeing private equity activity. So, most of our presentation will focus within the multi-specialty ophthalmology sector. But if you take a step back, we've seen a lot of activity, obviously, across the optical space as well. There's a recent deal with a Goldman Sachs affiliate that recapitalized My Eye Doctor, a group that's gone through several different iterations of private equity over the years. That space is much more retail focused. You also have kind of big box retailers that are still have big market share as well. You also have medical optometry, which there's really one very large consolidator within that sector called Eye Care Partners. They've been backed by FFL Partners for a few years now and are rumored to be pursuing a potential secondary transaction. They've been the first ones to really start to consolidate the highly fragmented optometry sector. They also have a meaningful optical component as well. That's a space where we're continuing to see additional PE firms enter the sector with a similar thesis to what groups are looking at it in the ophthalmology space as well. The multi-specialty ophthalmology sector, we've seen probably the most activity within eye care has been within this space. There's over 20 different private equity firms that have closed what we call platform transactions within the multi-specialty ophthalmology sector. Each of these groups has a very similar strategy in terms of investing into a high quality practice, building the infrastructure, augmenting the management team, and then looking at potential acquisitions both locally, but also with some of the larger PE firms that are in the sector, looking at new markets and new regions to move into through partnerships with other larger groups. The retina space is one of the newer trends that we've seen within the last year or so. A little bit of a different thesis from the private equity firms is they see retina as obviously downstream from referrals and feel that they can take retina groups and expand through acquisitions of their potential ophthalmology referral sources. It kind of brings a built-in acquisition pipeline. But one of the challenges we're seeing in the retina sector is just how groups are pricing these deals and in terms of the valuations for them, just given the concentration of profits on Eylea and Lucentis. Moving to the next slide. Yeah, this slide here really just illustrates from a timing perspective how quickly the private equity activity has accelerated within the eye care sector. Between 2014 and 2016, there were three platform transactions. So these stars represent new private equity firms that have invested successfully within the space. There were 3 deals over that 3-year period. And as you can see with the stars in 2017 and 2018 and into 2019 as well, there's been a tremendous amount of new private equity firms moving into the sector. Many of the larger practices across the country have either consummated a transaction or are in the process of pursuing one. And this does not highlight the other activity that's going on, which is all of these groups are also going out and making acquisitions of other ophthalmology practices. And as you can see in the table on the bottom right, there's been obviously a lot of good growth stories among some of the earlier investors within the ophthalmology sector, with ESP now up to over 220 providers. And then CEI Partners, a relatively new investment that's grown quickly with a meaningful acquisition that they made a few months ago. And then the next slide will highlight just a little bit more about what we categorize as the platform deals that have closed. So really what these transactions represent is a private equity firm consummating their first investment within the ophthalmology sector. Each of the groups on the left, highlights the platform companies, the names of the practices that aligned with private equity. On the right, we're showing really the management services organization that was created by each of these investments. As you can see, obviously there's been a lot of activity, since the beginning of 2017. With each of these groups, focusing on investments in different parts of the country. They have different theses that they're using. Some are focused on just regional growth, within a couple states, adjacent states of their platform practice that they invested into. Others are looking at a multi-regional strategy. So, building density within a certain region and then looking at, a new region by aligning with another platform-sized practice and growing around that practice with additional acquisitions and de novo locations. And then the next slide highlights some of the trends that we're seeing on more of the add-on activity. So each of the platforms that we've highlighted are represented by the green bar on the graph here. So there's been obviously a lot of platform activity that's happened in 2017 and 2018. We're starting to see more and more of the transaction activity shift to more add-on acquisitions. So these are groups that are sizable in nature, that have aligned with private equity-backed groups. So the groups on the prior page going out and making acquisitions of other practices. That's been an increasing trend that we've seen in the late 2018 into 2019, and we expect that this will continue to outpace the new platform deals that occur within the space. So below here, we're just highlighting a few of the many of these larger add-on transactions that have occurred. Of note, CEI Vision Partners, as we mentioned earlier, you moved into Virginia with a partnership with a large practice there. We've seen, Unified Vision Partners expand both in the Midwest as well as in Southern California with meaningful add-on acquisitions. And, there's been a lot of activity within the tri-state area up in New Jersey, New York region through several different private equity-backed groups. New Jersey Eye, Omni Eye, SightMD and Spectrum Vision are all within that market and are actively consolidating those regions as well. So we expect that these blue bars here will continue to outpace the green bars on the graph going forward as more and more of these private equity firms look to put capital to work and expand via acquisition. And one of the questions we always get is just, what's the positives and negatives of being quote unquote a platform versus joining a PE-backed company? And I think the answer has changed a little bit within the ophthalmology sector as we've seen more and more platforms emerge and obviously a lot more competition within the sector. But I think these are some of the general points that we see in terms of the pros and cons of both options. Certainly if you're a platform or you're joining a PE-backed company, in both cases you're getting access to capital through the private equity firm and through their relationships with third-party lenders as well. Looking at a platform, typically you're going to be leveraging the private equity firms and their outside advisors, board level strategic support. So PE firms typically aren't coming in with a management team. They're usually coming in with their own expertise, their capital, and they have relationships that they can leverage in terms of bringing operating partners to the table. That's a little bit different than joining a PE-backed company where typically they already have a management team in place. They have pretty significant infrastructure, and practices are able to leverage that through a partnership with a PE-backed company. One of the bigger differentiators between a platform and a PE-backed company is most typically a platform group is able to get representation on the executive board. That's usually not offered to add-on acquisitions. Typically they're reserving that for the original platform and for the private equity firm to either have individuals from the firm on the board and or include some operating partners on the board as well. As a platform, there isn't the need to really go through an initial integration. Usually your systems are going to be leveraged, your management team is going to be leveraged and augmented through the relationships with the private equity firm, but you're not necessarily integrating into the benefits or the EMR or practice management system of a PE-backed group. And then just from an equity perspective, as a platform, you're joining the organization at the ground floor. So, you're joining the organization at, probably the lowest price the stock will ever be, because obviously the goal of a private equity firm is, alongside their platform, is to help grow the value of that stock through acquisitions and de novo growth and organic growth. So as a platform, you do get the ability to see all that appreciation versus joining on the first or second floor if you're an add-on acquisition. But as an add-on, you do get, I would say, a shorter timeline to a secondary deal. So if you look at that timeline before we showed with the stars, obviously there's been a lot of activity in the last 3 years or so, and most PE firms look at a 4 to 6 year exit in terms of their timeline to pursue a secondary deal. So if you join a group that's been that's had private equity capital for a couple of years, there's the opportunity to potentially see a secondary transaction in maybe a 2 to 4 year period rather than the 4 to 6 for a platform. The negatives on kind of both sides, I think as a platform, probably the biggest negative in ophthalmology is that there's 20 plus other groups doing the exact same strategy or very similar strategy. So unless there's a very unique angle that the group has in terms of its market, maybe they're in a market where there is very limited competition from other PE-backed groups, or they're coming with a unique angle on maybe the technology side or in terms of what they're trying to build. I think there's obviously a lot of groups that are doing the same thing across the country now. So competition to make acquisitions after you receive investment from a private equity firm is certainly going to be substantial within the ophthalmology sector, rather relative to other newer areas that are seeing consolidation, but might only have one or two different private equity-backed groups. We talked about the longer time period to a secondary transaction. Obviously when you're joining a platform, there's no, necessarily best practices or management support that you're getting. You're getting support from the private equity firm in terms of their best practices at the board level, but not necessarily the day-to-day best practices that you would get by joining a larger, group with a lot of infrastructure. And then certainly it's not an option for all groups. There's certain thresholds of size that you need to be a platform. And I think markets also will need to be considered as well, because if it's a market where there are 2 or 3 different private equity-backed groups with presence, with a presence within that geography, I think it's less likely that you'll see a lot of interest from a PE firm looking to make an investment and see that competition with those groups post-closing. And on the PE-backed side, you don't get that board level support that you would, from a platform. Your groups always ask, how do you choose the right partner? I think there's a lot of considerations here, and these are 6 factors. You could probably list, 25 factors, and a lot of them are group specific, but here are some kind of general, factors that many of our clients will consider or that we would advise them to consider. So, certainly if you're looking at, joining a private equity firm or joining a PE-backed group, you really want to know what the track record is of that private equity firm in other areas of healthcare services. So a group that might have an investment with an eye care, but they've only been in the sector for 6 months, how do you know what their track record is in other areas within healthcare services? So we certainly always encourage groups to do their diligence on the private equity firm. How many funds do they have? What's the experience of the team that you'll be working with? Do they have other successful case studies in other physician areas? Because obviously a physician investment is very different than an investment in the home health sector. It's just very different growth patterns, and you have to deal with recruiting and partnership track. So we always have bias towards groups that have done this before and have that type of experience. There's always a question of what value proposition will this group bring to the table. So, capital is a commodity right now within, the private equity world. Plenty of groups have capital, but we really want to know what other, benefits are they going to bring to the practice, whether it's, potentially if it's a larger group in your state, maybe they can bring in some payer contracts on the commercial side that would, deliver an immediate uptick in your rates and therefore, provide an uptick in compensation for the partners. Do they have any vendor relationships that can result in some cost savings, or operating partner relationships if it's a private equity firm looking at this as a platform? There's also financial factors beyond the price that you get paid in a deal. Each of these transactions that we've seen within ophthalmology, and I think across the entire physician services sector, groups are expecting that you will take part of the purchase price in stock. So it's not going to be an all-cash deal that removes incentives for physicians, and is a model that's been proven to many times over to be unsuccessful. So these groups are paying cash in stock for the purchase price of these transactions that they're doing. And I think it's important to know what that stock price is. If you're joining a PE-backed group, how are they pricing their stock, and are they overpricing it? Are they factoring in synergies and other things that maybe are inflating the price of their stock, or are they increasing the multiple relative to the multiple that the PE firm paid 6 months ago? Those are the types of considerations that you would need to have. And certainly if you're joining a PE group, understanding what the PE firm's track record is. So if they have portfolio companies across healthcare, what are their average returns been for all of their healthcare businesses, and what are the outliers in terms of the unsuccessful case studies as well as the highly successful ones? All of that should be considered when you're putting a meaningful amount of the value of your practice back into stock. You want to know that that's going to be successful and generate a return for you. Otherwise, the valuation might look great on the surface, but the upside is much more limited than joining a group that is going to deliver a lot more equity appreciation for the shareholders. Certainly talking with references. So if it's a group that's been in the space, they should be able to give contacts of other physicians that they've aligned with, and should be able to give many of those types of contacts. If it's a PE firm looking at an initial investment, they should be able to give contacts of other portfolio companies and physicians that they've worked with, so you can speak with them, and ask about their experience working with that particular PE firm or strategic company. It's also important in terms of which groups this particular group PE firm has aligned with. So if it's a group that's already in the space, what other practices are part of their network, and what are the reputations of those groups? I think that's a critical part of what PE firms are trying to leverage is, aligning with groups that have, strong clinical quality. And, if you're looking to join a group, you should, do your diligence on the other practices that are within that PE firm's network. And then just, simply cultural alignment. So, anytime that you're doing a transaction, the numbers might look great, but if it's it's a team that you don't feel like you could ever work with, then, I think it's very short-sighted to do a transaction just based on the dollars and cents. I think you really want to know, is this a group of individuals that I can continue to work with going forward, and is there a fit there culturally with our company? All of that should be considered when you're looking at a potential deal. And then the next slide, before I hand it over to Jonathan. So, the question we get as well is, where is, the consolidation in ophthalmology heading? And I think the first answer is that no one can predict, exactly what's going to happen in this space, because obviously there's a lot of other macro changes that can occur that would, change this answer. But I think there's some general themes that we've seen within other physician areas that will really tell us where this is going. So, we talked earlier about the platform investments. We still think there will be additional platform investments. There's now over 20 groups that have invested within ophthalmology. It's, relative to dermatology, it's basically caught up in terms of the number of investors that have moved into the space, even though dermatology consolidation started a few years earlier. But we still think that, the ophthalmology sector is larger than dermatology. There's 18,000 ophthalmologists. There's still plenty of large groups out there, and there's some markets that have seen very limited consolidation. So we still think there will be additional PE firms that move into the sector that have yet to make an investment. Of course, we think there's going to be a lot of add-on transactions. So, the theme that we've been seeing more and more often over the last 6 months or so has been PE-backed groups acquiring other practices within their geography, or moving into new geographies with more regional platform type acquisitions. And that's going to continue to dominate the headlines in terms of, the PR, the press releases for these groups going forward. Each of these groups needs to build scale. They want to do acquisitions, and, and we're certainly going to see that become the most common theme across the eye care sector going forward. And then there's also going to be secondary transactions, because private equity firms, when they make their investments, the way that they generate returns is by exiting that investment over, typically a 4 to 6 year period. So if each of these 20 plus groups that's invested has the same thesis, which is that they're going to grow the business, grow the value of the business, and then pursue a secondary recapitalization at a later date. We've seen one so far within purely the ophthalmology side with Eye Care Services Partners, and they actually exited in 3 years, which is a very quick turnaround, but is probably more reflective of the fact that they were the first mover in the market and didn't have much competition for other transactions. And now they're backed by a much larger private equity firm that's been accelerating, the growth that they achieved over that 3 year period, and is continuing to do acquisitions at an accelerated pace. We'll see a very similar theme across, the other PE firms. It doesn't mean that they're necessarily always going to exit to a larger PE firm. What we'll start to see at some point as well is that some of these PE-backed groups will end up coming together, emerging together through, transactions. And we've seen that in other areas that have been consolidating for a lot longer, like the dental sector, which has been seeing consolidation since the 90s, and certainly accelerated a lot more with private equity activity in the early 2000s. We've also seen that within, the outpatient physical therapy sector, which has been seeing investments since the mid-2000s. 2000s, some of these larger PE-backed groups have begun, coming together as well through secondary transactions. So I think that the first few will likely end up trading to larger PE firms, but then down the road, we do expect that some of these PE-backed groups will end up selling to each other as well to create a multi-regional or even national provider. We're still very much in the early stages, though, with the largest player in the space is in less than 10 states. There's still a lot of fragmentation in the market and a lot more growth to be had. I'll turn it over to Jonathan to go through some of the slides as well.
Thank you, Eric, and I hope everyone is going to be able to see sort of the reason for the collaboration between Provident and Edelstein. Although we may touch upon some of the same topics, it's from two very different perspectives. Provident's experience with the investment banking and the buyer's market, and Edelstein's experience with the private practice working with our clients. I want to talk a little bit about some of the major reasons to consider a transaction. Obviously, this slide is not all-inclusive. You'll have your own reasons for doing so, but I'd like to review some of the more common ones together. We've broken them into two groups, financial and other. One of the more important ones is a favorable valuation, whether the physicians that own the practice have done their own research or hearing from their counterparts. When they hear the amount of money that they may have thought might not be feasible for their practice that they could even consider, there's just an automatic interest in exploring this opportunity. Future financial opportunities, as Eric alluded to, often when you're owning a portion of your buyer, which we'll talk about in a little bit, in terms of the purchase price that comes in equity, there are better opportunities perhaps at a second, third, and fourth future sale than the initial opportunity that you had upon the initial transaction. Economic pressures, I'm sure that we've all heard the phrase that I'm working a lot harder and making less or the same money. That tends to be a common physician theme, even if it's often not true or close to not true. You have increased overhead pressures, increased salary and benefit issues. You may have increased drug costs, and just overall sustaining your normal level of profitability in healthcare these days is becoming much more challenging each year, and we're to the point where your owners will want to explore these various opportunities. Changes in reimbursement rates, I don't think this isn't new news. There's pressure on our fees every year. The continued transition to quality care over fee-for-service is putting constant pressure on all of the practices out there and is making it more difficult to run as efficiently as possible. We're spending a lot more time really on the administrative challenges that we have to deal with. Drop in patient volume and in revenue. If your referral patterns have changed, or we talked about the reimbursement rate changes dropping in your revenue, or you have more physicians that want to work different schedules. All of these factors lead to your groups being concerned about owner compensation, which again becomes a major reason for considering the transaction. And finally, in the financial column, expense savings always creeps in there. It's never a driving consideration, but as you start to consider various opportunities, you realize that you may have some purchasing power and other opportunities to really reduce expenses and as a result increase shareholder value. On some of the non-financial components, the ability to expand geographically, we've seen a fair amount of deals that have allowed our clients to expand even within the area, open additional practices in areas that they thought were underserved strictly because of the additional capital available. Also expanding their subspecialty practices. Again, groups have taken opportunities from better leadership, better advice, better capital, and has allowed them to work in areas and subspecialties that they've always wanted to, but may not have been able to do so on their own. One major impact we've seen is the increased ability to recruit, the resources that your partner may have and the networks they may have likely have the ability to bring in better candidates into your practice. It's been a major plus. Healthcare reform, technology and regulatory changes, again, the ability to utilize the resources of a larger organizations makes dealing with many of the complicated items that you wrestle with every day and take up a lot of your time a little bit easier to handle. And then finally on this slide, just the fear factor. A transaction like this has a big human component to it. There's often the reluctance of the existing owners to sell at times until they hear that the people down the street have sold and the amount of money they may have been discussing. And then it becomes sort of nerve-wracking to them. I kind of relate it when we're initially having these discussions to their neighbors sell their house at a price that is very attractive to them, and then they consider selling their personal residence, even though at the time they really didn't want to move. So these are some of the transactions, some of the reasons you're going to consider a transaction. And now I'd like to move on to some of the characteristics that we see in these transactions. Probably one of the, and you may have heard of this term quite a bit in the past, but now really taking the forefront, is earnings before interest, taxes, depreciation, and amortization, or EBITDA. That is basically the multiple that is used to determine the transaction price. And we're not going to spend too much time on it now because we're going to talk about it in a further slide, but it's not as simple as the definition looks at. It's not just those 4 or 5 terms. There are many adjustments to EBITDA that you'll need to consider along with the buyer. It's very collaborative effort. We'll talk about those in a few minutes. Rolled equity, that's something that Eric alluded to and we can talk about here. Generally, there's a portion of the purchase price that is paid in stock of the buying company. It has 2 major reasons for doing that. One is to incent the selling practice to still be a valued member of the buying entity. And 2, that portion of it is also in a complex series of transactions that you can let your professionals handle, becomes tax-free. So if you were selling for X and as part of X, there's a portion that's in stock, that stock portion is tax-free to you and is a real big incentive driver. Again, as we've alluded to a little bit, there's second sale opportunities, which is the ability after the initial transaction, as the valuation of the entity that you've become a part of increases, to really be rewarded if you're a valuable member and the practice continues to grow with their future partners, to consider to be involved in a transaction that is oftentimes more significant than your initial transaction. Control changes, I think when you talk to your team, it's something that you hear about right away, and a reason why they don't want to do it, which what we found a year or 2 out is that the control changes are not as bad as initially feared by your owners. Yes, you may still have a couple things and ways you wanted to do certain things and not happy with exactly how everything goes, but we found that the adaptation of the physicians is generally quicker than you would initially probably hear among your initial discussions with your owners. We've talked about it. The operational opportunities are enhanced, better resources, best practices, better ability to recruit, expense savings, and probably other things that you wrestle with every day become a little easier when you're dealing with a team that has developed ways to really conquer those problems. Eric referred to it, competition among buyers. Yes, there are specialists in each specialty, but there's also opportunities to speak to more than one buyer and make sure that your group is happy with the overall fit and just not the financial fit. That's very important. Yes, groups are initially maybe attracted to the initial financial component, but the overall fit as you get down the road in negotiations becomes just equally as important, especially if you're looking for your group to be really happy and content after the deal closes. One thing that I wanted to point out here that's a characteristic, although I don't want you to worry too much about it because your professionals will handle it for you, and that's just not a selfish plug on my side, that's just reality, is that a lot of additional entities can be created and it can get a little complicated, but all of the steps are taken for the benefit of both the seller and the buyer. Again, we mentioned that tax-free rollover in the equity component. That's part of the reason you have some additional entities created. You have to house possibly the billing and where the physicians are working in another entity that might be separate from the operational aspects of the practice. It may sound more complicated than it is, and I don't make it to sound that way. I just want you to be aware of that. That's something that actually happens as these transactions start to unfold. A couple of other interesting things we've seen is ownership changes among the original owners. So as you're negotiating your transaction and these other entities start to evolve, we've seen the existing shareholders actually come into arrangements where they're even changing ownership amongst themselves. It's for various reasons. It might be retirements quicker than others are anticipating. It could be productivity discussions that they've had in the past. And so when you're setting up these new entities, I've seen a few times where the ownership of the new entity is quite different than the ownership of the entity that initially entered into the transaction. There's also opportunities for non-owners. So you're going to have some key folks in your practices now that don't have an equity interest in the practice, but are very vital to the practice and need to be retained post-transaction. So there are times where there have been very special deals for them, including profits interests, so they can share in the increased value of your entity and the buyer entity going forward. And last but not least, I left it because I'm sure all of you are aware of it, is the tax implications of the transaction. Obviously, it's important to consider. The one thing that people may not think about and you need to plan for is it's not completely a capital gain transaction. There will be some ordinary income and possibly AMT tax components, depending on what type of asset you're selling, and that goes along with the negotiations. But it's important to consider that when you're thinking about the cash flow that will eventually go out to your owners, all of the aspects of the tax transactions have to be considered. So I would like to circle back on the next slide to the first bullet so we can expand a little bit more on the EBITDA. So as you probably have heard, the EBITDA is kind of the driving force behind the sort of determining the purchase price. There are a million ways that you really should look at EBITDA and make sure it's the right figure. And I'd like to point out that the buyer is on the same page as you. It's not necessarily a us versus them negotiation. If you're at this point, if you're talking with the buyer, they want to collaborate with you because they want you to be part of their team. They also want to arrive at a very fair and correct purchase price. So it is a very collaborative effort at how you work and get to your EBITDA due diligence factor. A couple of the more important items that I'd like to just touch upon briefly is cutoff procedures. So for example, when you're looking at EBITDA and you're considering your revenue, are you looking at it on an accrual or a cash basis? You need to make sure that all of your items are being properly billed and properly accounted for, as that obviously makes a big difference on your EBITDA. So possibly a year or sometime before considering the transaction, and obviously practices should be doing this anyway, but you're really evaluating and considering what billing issues you've had, how they impact you, and how you can correct them from an EBITDA calculation. Another big item is personal expenses. So you really need to look at, we can throw out the standard accounts, the meals and entertainment, the travel, the cell phone, the automobile, but there are other accounts, for example, like charitable contributions. We've had quite a few practices that are very charitable, and they're an S corporation in terms of that the shareholders could have made those contributions personally, but decided to make it through the practice from a marketing perspective. And that obviously affects the income of the practice, which if you weren't thinking of that during your calculation, impacts your EBITDA calculation. You really need to think about all those accounts that may have some component to it that could have an EBITDA adjustment. Understanding of provider and practice fluctuations. There are things out there that the buyer may not know, that you will absolutely know, that impact your profitability, that should be discussed together. Another important item is normalization of owner earnings. I'll use the S corporation example again. We have various clients that, because of various productivity components, flow most of their things through wages and not necessarily distributions. So the owner salaries may be higher than what the market would normally dictate. So a normalization adjustment on earnings is very common, because if the owner is making $50,000 more than the market would dictate, should have been a distribution, that's an adjustment which, after you consider the multiple, very much impacts your EBITDA calculation. Compliance. This is obviously very important, perhaps not always on an EBITDA perspective, but it's very important to make sure that you have everything sort of where it should be, in terms of your coding, your documentation, your workflow. As part of due diligence, and we'll talk about this on a future slide as well, it's a long process and the buyers are very thorough. And these are probably best practices for your practice anyway. You just want to make sure you have all these items in order. And generally, one thing I like to talk about is just an overall financial statement review. I think it's a good idea to really review all your accounts in detail, just to have an understanding of what is and isn't in there. So if there are any odd issues, you can discuss and have them addressed, or discuss with the buyer really before they come up. An example that we see often, beyond the benefits that we talked about above, there are many practices that might have various expense accounts that they allow their physicians to utilize for various reasons, and how those impact each and every line item on your financial statement makes a big difference. This slide served as a brief example of some items to consider on your EBITDA calculation, and we could probably have a whole webinar in this area, but I'd like to move on to some of the other important considerations on our next slide. What I tried to focus on here are sort of the non-financial aspects when you start this process. One is that the process actually, and we've talked about it, starts well before the sale. I know that sounds very obvious to you, but the planning and discussions with the buyers and your counterparts, that might be a 6 month to a year timeline before you really get into discussing the nuts and bolts of paper in the transaction. Yes, generally the buyer may want to close quicker, but it's usually a lengthy process. I've mentioned it on the last slide, but the buyer is very thorough. Again, something that might be obvious, but if you know there's 2 or 3 things out there that you haven't really dealt with yet, it's helpful to get those wrapped up, buttoned up, and cleaned up prior. It'll save you a lot of time during the process. It's important to know, and Eric alluded to this, that due diligence goes both ways. You have the right to be as thorough as possible on the buyer, as the buyer has the right to be as thorough as possible on you. It's not necessarily, in my mind, I don't necessarily view it as a sale, as a collaboration, as a partnership. You're trying to find the right fit, and they're trying to find the right fit, and you both should be very inquisitive of each other. One thing we've seen sneak up quite a bit is state tax implications. I believe we do have quite a few different states on this call, so I may not be able to give examples on every state, but you need to be aware, everybody's aware of the federal tax implications, and everybody's aware of the state income tax implications. But there are quite often unique examples at the state level that may impact your organization in ways you may not have thought of. I can use my home state as an example. In Massachusetts, there's a tax on the net income when your sales exceed when your revenue exceeds a certain dollar amount. So quite often with our clients, they do some significant year-end tax planning that via physician bonuses, even if they have a high revenue number, they're able to eliminate the net income. However, in these transactions, when we had the proceeds coming into the entity and they're distributed via a distribution, perhaps that by distributing via distribution, that keeps your net income number higher and creates a state tax at the entity level. I can use another example of a local state in my area, New Hampshire. New Hampshire has a tax on dividends. So if you're distributing that money out to the shareholders, that creates a little example that you may not have thought of. And we've seen more than once situations where everyone's excited and money gets distributed out and the tax return gets filed later in the year, and you're going back to the physician group and asking them to cover some state tax implications. that's not really a great board discussion to have at that time. Talking to peers. One of the first things I try to do and is when we're approached by a group about the thought of selling, we connect them with a group that has already sold. I find just really comforts your group in terms of understanding what to expect, what to discuss, what to negotiate, and whether or not it's the right fit with them. Arrangements with existing partners, as I've mentioned, you can negotiate with your existing group separate deals along with, in conjunction with the sale transaction. Those have tax consequences themselves that you have to be aware of. We've seen groups change ownership percentages, and as a result, that's actually compensation to the individual, but also a large payroll tax obligation to the entity. So when those things happen, again, you need to be discussing with your advisors. Some of the more fun things that I see, and I'm putting fun in quotes, is the post-transaction accounting. There's a period of time where you're likely going to be sharing the same cash account with the buyer. Just for ease of transition, your electronic deposits are still going to that account. You're clearing up your receivables, clearing up your payables, and there's a big kind of post-transaction accounting and reconciliation process that has to happen to make sure we exactly understand who owns what dollars. Another sneaky component that's come on to us is the finalization of the retirement plan. There's a lot of notice that has to be given to the current participants in retirement plans. And depending on where your transaction closes in the year, you may or may not be able to control the amount and the timing of that retirement plan contribution. And often that obligation could be large. So you really need to think about closing your retirement plan in conjunction with the sale of your entity. Reconciliation of compensation. We've seen often, generally the owner method of payment will change. And we've caught mistakes after the fact when, if you're paid on a percentage of collections and you're paid on that you're supervising an NP group, we've seen calculation errors in the compensation when we go and ask for supporting detail and recalculate the compensation and find out it wasn't necessarily correct. And finally, one of the biggest reconciling items is generally in these transactions, there are escrow accounts that are put aside to sort of cover for anything that nobody knew about. If you have some litigation that people weren't aware of, your accounts payable was significantly underestimated. So generally 90 to 180 days after the transaction, there's a big reconciliation that has to happen to resolve any final open items and really close the amount of money that is due to you. And that also takes some time and diligent planning in understanding what you need to hold back before distributing, just in case, and it occasionally can happen more often than not, that the selling price may be adjusted the other way if you were too aggressive in some of your estimates. So as part of the discussions that surround the purchase price, including these important considerations, we're also going to be talking about, I'd like to look at some items that you can negotiate in your employment contracts. I won't spend too much time here because they're on the slide and I want to save some time for questions. But these are some of the major items that you're also able to negotiate when you're looking at your employment contract. Obviously, compensation is one, but you can talk about quite a few items in your compensation, not only what you're going to be paid and how you're going to be paid, but how you're going to participate in maybe some non-qualified arrangements or some pre-tax arrangements. The term of employment is very important. They're going to want you to keep your schedule, and you're going to want you to keep your schedule, but you should also discuss some potential retirement plan timelines, potentially cutting back, potentially when your shares will vest, other things of that nature. Benefits and expenses, again, self-explanatory, but does leave some room for negotiation. It's often hard to negotiate the benefits because those are in place. But it's important to understand if you're stepping into benefits that might be valued less than what you had, if there's an adjustment that you can make to your W-2 compensation. Sign-on bonus, I like to put it here as sort of a pie in the sky. It's pretty rare, but it's still an item that has come up and can be discussed. Same with income guarantee. You'd obviously like to protect your compensation from any downside risk for a certain period of time as long as you can. Payments via WRVO methodology. This could be something that's very comfortable with you, very measurable for you, and you might like to negotiate that into how you get paid. I've seen it in recruiting of new physicians, where that you agree upon how you'd like to grow the practice and how you'd like to grow this area, and resources are committed to assist with the recruitment of physicians into the practice. I think the co-management of certain areas of the practice is very common. You might have control over NPs and PAs, and you get sort of a management percentage of their cash receipts. Restrictive covenants is also another important area. This is one I will caveat that varies by state, but depending on your future plans and what you like to do personally or your practice like to do personally, this is a very important area that probably should be carefully considered and tailored to the various state laws. Outside income, could be many members of your practice that are receiving some outside income currently that they don't consider to be part of the practice. And if this is the case, needs to be negotiated and discussed again very carefully. Real estate's another big item that we could probably have a separate webinar on. I just want to touch base on it quickly. That if you do happen to own the building that you practice, you need to really determine, obviously, whether or not the real estate is part of the transaction, how that impacts the EBITDA, and whether it impacts whether you own it or not, discussing a fair market value lease and agreeing to that before the transaction closes. And then finally, the incentive parameters. The physicians know best where in what environment they operate best. And if that's the case, it's very important to kind of negotiate those items sort of ahead of schedule, how you think it's best for your group to be getting paid. And next slide, please. This is just, and Eric alluded to this as well, an example of why we believe that the private equity area is still hot in the physician practices group. This is just through February of this year. If you look at the right-hand portion of the slide, you can see that their physician practice and services makes up a fairly large component of the pie, and it's 37 practices that have been made aware of in the first 2 months of the year. So it's still an area that is has a lot of room to grow and is heading in that direction. And without any further ado, I want to turn it back to our leader of our presentation.
Thank you everyone for joining. We'd like to now open it up to questions. And again, you can find the question box located in the control bar, which is on likely the top or the bottom of your screen. It'll just say Q&A, and you can go ahead and type your questions right into that box, and our presenters will answer them.
So one question that came up. So how do you determine a good time to explore the market? I think this one's a tougher question to answer just generically, because I think it's certainly dependent on the practice. But I think there's really general guidelines as it relates to the overall market, which is more of a macro perspective, and then also as it relates to your specific practice. So on the market side, obviously, that's dependent on the cost of debt, which is how private equity firms typically are using debt and their equity to finance these deals. So as long as the cost of debt is low, we've continued to see valuations remain very strong. I think the market itself has seen very strong and consistent valuation market, and also just the global economy has done very well the last decade or so. But I think as going forward, there's certainly going to be some sort of pullback in the market, and certainly valuations will probably be affected as well. But the timeline of that, I don't think anyone knows at this point. But certainly that's something that needs to be considered by groups, in the cycle of their practices. while you might be much larger 2 years from now, does that mean, is the market still going to be as robust as it is right now? And we've seen the benefit of a very strong, valuation market across healthcare services and specifically within ophthalmology over the last 2 to 3 years or so. The other factors obviously are practice dependent. So, if you're in the middle of a high growth phase, some groups may say that it doesn't make sense to do a deal. On the flip side, I think the other part is that obviously as you continue to grow, you're likely adding more and more partners to the group. So, the question becomes, are you really adding incremental equity value for your existing partners as you continue to grow, with new physicians that eventually become partners and dilute the ownership to a larger group. So that's a consideration that many groups need to have as well, is while you might be in the middle of a growth phase, is that necessarily going to add incremental equity value for your owners by waiting? And how can we factor that into a potential valuation as well?
Another question that we have here is, how can leadership structure and characteristics of the practice make a company more attractive? A little bit of a tough question to answer, but I think really, if you walk into a practice and you spend some time with the practice leader, you can really tell the quality of a practice after a few meetings. What I like to look at is the quality of the physician leadership. I think the personalities of the physician leadership makes a difference. If you have strong non-owner MDs and NPs and PAs, that's also incredibly helpful. We try to really look at how successfully the practice runs overall, even in terms of cohesiveness of the owners. Characteristics like that make a difference and show themselves to potential buyers. So yes, it's finances and it's productivity and potential value there, but it's also how well the group works together. It might not add value per se in your EBITDA number, but it adds value in the competitiveness of the buyers that may want to purchase you, and increases the attractiveness of your practice to the potential buyers out there.
It looks like we're actually just about out of time for today. If anybody has any other questions, the contact information for both presenters is on the screen right now. You can feel free to reach out to me. My name is Gina Casiello, and I can direct questions at the presenters as well. And just a reminder that this webinar will be recorded and we will distribute it next week. Thank you so much, everyone, for joining, and enjoy the rest of your afternoon.
Thank you, everyone.